Thank you for joining us, St. Louis. This is What Retirement Means to You with financial advisor Jerry Means of the Means Financial Group. I am Spike Spengel. Jerry, how are you doing today?
I'm doing fantastic, Spike. Family is healthy, playing with the 4 grandchildren. Everything's good. How's life for you right now?
Busy. And, we're kind of in a planning year. There's a lot of different moving parts that are going on. So I wanted to ask you, what do you want to talk about today? How do you want to help the folks?
Well, I thought we could talk about money mistakes that can really cost you.
Oh, right. Money mistakes that can cost you. Oh, boy. Yeah, nobody likes making mistakes with their own money. We try to protect it as much as we possibly can. So I tell you what, for a lot of our viewers, some of the money mistakes that can really cost us over a long period of time start in those retirement investment accounts, 401ks, our IRAs, but there's also different tax versions. Is there a better version? Is there a cost to you for not considering Roth or only using traditional tax deferred? Do you have a preference with either one of those?
So more times than not, I find that it makes sense to blend those strategies because when you're putting money into your 401k, for example, you're getting a tax deduction on your income at the end of the year. You're reporting less taxable income. It's not necessarily a deduction, but it's less reportable income. When you're putting money into the Roth, you're not getting that deduction or that savings. However, it's growing tax deferred. And if you play by the rules, all of the money comes out tax free, not just what you contributed, but also all of the growth will come out tax free. So I think a lot of times people go one way or the other. But if you're near retirement and you're in your highest earning years, sometimes contributing to that pre-tax account makes sense because you need that deduction. But don't forget about putting a little bit into the Roth because although it might not feel like you're saving money now, you're going to look at down the road and say, hey, there's all these other ways that this Roth helped me out. I'm glad that I put some money in there. And when I meet with people, one of and this sounds self-serving, but one of the biggest things people say to me when they come in is, Jerry, I wish I'd have met you sooner. Because I really try to take the time to educate them on all these different topics. And when I'm starting to go through their portfolio to do a review, I'll see the IRAs and the 401ks or 403bs, whatever their qualified plan is, usually their biggest asset. And then they have $8,000 in their Roth. And they'll say, I really wish I would have started that sooner, but no one really explained it to me. I wish I would have met you. You could have explained it to me. So I go ahead and I explain that to them and help them sometimes even call their HR or their custodian and make sure that they're starting to contribute some of the money to the Roth 401k. Some people don't even know if their plan has a Roth availability. So I help them find that out.
Something we want to share with our viewers today is a free tool that you have put together. We're going to bring up meantaxes.com. And as Jerry always says, sometimes taxes do feel mean. But what this tool is, if you type that into your web browser or if you scan this QR code, it's going to take you over to the Mean Taxes, kind of the assessment in there. You're going to put in a handful of simple inputs. You're going to know the inputs. If not, you can estimate them. It's how much do you have saved in your tax deferred accounts? Could be 100,000, 300, a million or more. Put in your input in there, and then you put in an estimate of what your tax rate is. If you're uncertain, just try to guess what you kind of paid in tax rate last year, 22, 24, maybe up in the 30s. And then it's going to spit out for you exactly how much you're going to owe in taxes on what your accounts are right now. That's without any more growth. Now, Jerry, when you've shared the mean taxes, people have come in with this written page of how much they owe. Are they happy about it? What's the reaction when they see it?
It shocks a lot of people. But that's because when you go to the tool and you put in your qualified money, like your 401k, it'll show you how much you would pay in taxes today if you did a conversion of all of that. We're not recommending that people convert all of their money at one time. We look at doing it strategically over multiple years so that they're not getting hit with that big tax bill. But a lot of people don't know, how much do I do? Where do we put the money after we do that? How does it work? What does it look like? What's our tax return going to look like after we do this? I walk people through that step by step and show them how to do it. So the calculator is a great place to get started and to see what your numbers look like. But then we always follow up with a phone call and say, hey, would you like us to explain the report to you in person or over the phone? Or would you like to come in for no cost, no obligation consultation to sit down and talk about tax planning and Roth planning? Because it's a great tool. I mean, you want to talk about things that can help you with, Spike. The tax-free retirement can help you with potential savings on taxes on Social Security. Maybe you're paying 85% tax on Social Security. Maybe we can get it down to 50%. That's a big difference if we can do that. When you're looking at things like the IRMA, which is the surcharge on Medicare Part B premiums, where they look back at your income for the last 2 years since you retired, some people have to pay extra for the Medicare Part B because they made too much income. Well, this is tax-free income. It's taxable income that they look at. So it's a way to help avoid the IRMA tax. So all of these different things are ways that we can help people with this tax-free planning.
It's got to be hard, though, to try to convince anybody to pay a little bit more taxes. And I don't mean more than your tax obligation is over your lifetime, but paying the taxes a little bit more up front to create tax-free income later. If you pay some of those taxes now, you've heard this, especially here in the Midwest, paying on the seed instead of the harvest.
Mm-hmm.
Can you explain that?
Yeah, so I was going to go there, actually.
I stole it.
Thanks for throwing me that softball, Spike. So I often use that to explain it to people because they still have trouble wrapping their heads around it, right? And that's why we do illustrations and reports. But basically, when you put money into your 401k, you're getting that tax deduction. You're putting the seed into your 401k. But then that seed grows and mushrooms over years of compounding and contributions and matching and hopefully market growth. And now you've got this big crop that's all taxable income when you pull money out of it. When you put money into a Roth, you're not getting the tax deduction on the seed. You're actually paying the tax on the seed. But now as it mushrooms and does that same thing, as long as you play by the rules, which is over age 59 and a half, and it's in there at least 5 years, all of that money is tax-free, that whole mushroom cloud. So again, it's just another way of doing things. And I ask people, if you were a farmer, would you want to pay taxes on the seed that you're planting or on all of the crop that you harvested? And it's always the seed, but people are doing the opposite in their 401ks. Not saying that you shouldn't put money into your pre-taxed accounts, but you should be aware of the Roth contributions and what that could look like, because it could save you a lot of money in taxes down the road. Because as you know, Spike, we really believe, I believe that taxes are going up in the future. You know, we're looking at a $40 trillion national debt, and the fastest way to pay that down is lower interest rates and also getting more tax dollars coming through the door for the government. So I really believe somewhere down the line we see an increase in taxes. But hey, if you have this tax-free plan, it's not as big a deal for you.
Yeah, let them change taxes on you later if you start to pay some of your tax obligations now. To add on to that real quick, we're also in some of the lowest tax rates in U.S. history right now. And I know a lot of Americans out there don't feel like that because we have tax on everything. But these are literally some of the lowest tax rates in U.S. history. So should you pay a little bit now, paying on the seed of what's going into those investment accounts, or wait for it to grow even larger 5, 10, 15, 20 years from now? To answer that question for yourself, call the phone number on the bottom of the screen. Schedule your time. I often ask this question, going into retirement, which is more important, your investment returns or your tax returns? You don't want to find out the wrong answer to that question in your own retirement. Call 844-878-1293 right now. Schedule your time. Sit down with the team here, Jerry Means and the Means Financial Group. We'll be right back with more money mistakes that could cost you right after this.
I started working in the retirement market, seeing people during the day. And what I quickly found out is they had a really unique set of challenges that were different than everyone else. They were worried about longevity and outliving their money, worried about long-term care, how they were going to leave their legacy to their children and grandchildren. So I really focused my practice on that. And that's what I've been helping people with for the last 25 years. It's an ongoing process. Life changes, family dynamics change, the markets, the political environment change. So really sitting down and have a written plan. We want to make sure that you stay on track to stay retired, right? The worst thing is to be 80 years old, run out of money, and have to go back to work. We want to stress test all these different scenarios and make sure that their plan is going to stand the test of time. You can't do that if you don't have a written plan or a strategy in place.
Welcome back to What Retirement Means to You with financial advisor Jerry Means of the Means Financial Group. We're talking about money mistakes that can cost you. Talking about our retirement accounts, 401ks. Should we do tax deferred, Roth? It's really an individualized question and answer. Next one is diversification. Now, diversification for our portfolios. We hear we should do that all of the time, but can diversification cost you sometimes?
It absolutely can. A lot of people think diversification is just owning a bunch of different stocks or mutual funds or exchange traded funds. or diversifying between stocks and bonds, right? The 60-40 plan. If you're a moderate risk investor, 60% equities, 40% bonds, because they used to work opposite of each other. I wouldn't say that as much anymore, because that used to be the safe part of the portfolio. But an example of recent history in 2022, when the Fed raised interest rates 13 times, that dropped the stock market, but also existing bonds went down in value. It was actually the first time in U.S. history that both stocks and bonds lost double digits in the same year. I had a client, they're a client now, but at the time they came in from the TV show and they sat down and said, Jerry, I lost 20% this year. I thought I was moderate risk. And I said, well, let me look at what you have. And they had one of those 60-40 target date funds. And I explained this to them, like, well, when the interest rates went up, people were saying I can get 5% at the bank, guaranteed, and with zero risk. I'm going to sell out of the market and I'm going to go get that safe money return. Well, when they do that, the market is supply and demand. So less people in the market goes down. So when they were in that sell-off, and you'll hear that phrase often in the media, the sell-off. They'll pull money out, go to the bank. When you have a large wave of people doing that, it drives the market down. At the same time, if your bond is paying 3% and you could get a 5% bond, who wants your 3% bond anymore? So you have to sell it for less. And so that's how we've seen those double digits. So it's safe until it isn't. That 60-40 is not always safe. But then what we see a lot of times is overlapping. I'll have clients come in and we'll evaluate their portfolio and they'll have maybe 10 different mutual funds. And they'll say, I'm really well diversified. But a mutual fund is just 30 different companies, roughly 30 different companies inside the fund. So it's diversified on its own. But here's the thing. I can look at 10 mutual funds and they might be 80% of the same stocks or same holdings. So it's not really diversified. They just have different titles on the mutual funds with the same holdings inside. We're seeing a lot of that right now with like the AI stocks and technology and things like that. So they think they're diversified. They're trying to do the right thing. But you really have to get in under the hood sometimes and get into the nuts and bolts to figure out, are you really diversified? And we help people do that. And we do that at no cost and no obligation when they come in.
What is the answer to something that happened in 2022? I mean, interest rates, it changed 8 or 9 times that year. That panicked the stock market. They both went down. You say the first time in U.S. history. Do you see that kind of event repeating itself, or do you have to check what kind of diversification you have to make sure you're, I hate to use jargony word, but like totally uncorrelated?
Yeah, so you want to, and that's what uncorrelated means, is those mutual funds not having the same holdings underneath them. So you want to make sure that you want to look at, do you have large cap stocks, big stocks? Do you have small cap, mid cap? Then you want to look at the bonds. Are they government bonds? Are they corporate bonds? What are they rated? There's all these different ways of diversifying. Maybe you need annuities for income, things like that. But what also is to keep in mind is diversification of tax buckets. It's not just your actual holdings. People say, well, Jerry, I own gold and I owned these stocks and I own these bonds, I'm diversified. Well, now let's look at your tax buckets. Maybe you are diversified, but do you have all of your money in pre-tax accounts? Is there anything in a Roth? And anything in after-tax accounts so that you pay capital gains rates? So again, tax diversification is a broad
diversification. Yeah, because then we were talking about assets. Now we're on diversification. Going back to our first question, diversifying your tax strategy, not just saving everything tax deferred or paying tax on everything, a diversification of the way that you look at the tax structure.
Yeah, and I'll take it one step farther, Spike, is diversifying your income buckets, right? A lot of times we'll have people in a shorter income strategy for income today or income in the next few years. We're not taking as much risk on that. And maybe that's diversified a little bit differently than the next step for maybe the next 7 to 10 years after that. And we want to have an income plan inside that strategy. Then you want your growth bucket to help fight inflation. And especially if it's a Roth, a lot of times I recommend people to go more aggressive. If they're going to have aggressive holdings in their portfolio, to do that on the Roth, because over time, we've seen the stock market goes up. Well, if you're not going to touch that Roth because you're getting that tax deferred and tax-free growth down the future, why not have that be your bucket for the long term?
For the longer term, take a little more risk. On the bottom of the screen, we want to let our viewers know, meantaxes.com. Yes, we know that taxes feel mean at times, but what this is a tool for you to use to figure out how much you're going to owe in taxes on what you already have in all of your tax-deferred accounts. You can estimate that for future down the road if you continue to save exactly the same way, but how much do you have saved in your tax-deferred accounts? eventually you're going to have to start taking that money out, whether it's RMDs or passing it to the next generation, but you're probably going to need it for income when you go into retirement. So would you like to control how much you pay in taxes? Would you like to maybe stop the tax calculator, the tax compounder right now on your accounts? Well, find out how much you owe in taxes right now on your tax-deferred accounts. Go to meantaxes.com, type that into your browser, or I know most of us watching TV, you got your phone in your hand there, open it up to the camera function. Point it at the black and white box and then click on it. It'll activate. It'll take you over to the tax quiz and you can do it right there. It's a handful, couple of simple, easy inputs that you know. What you have saved in there, what your tax rate is, your email address, it's going to shoot the report right over to you. Speaking of, what I ask you about from there is tax strategies and Social Security. What I understand is one of the money mistakes that can cost you is taking Social Security at the wrong time. But how can that cost you if you're getting income from Social Security?
Well, if you're taking Social Security early at age 62 versus your full retirement age, and for most viewers out there that have not reached full retirement age yet, it's probably 67. We were at a point where it was like 66 and 8 months, depending when we were born, or 66 and 9 months. But we've kind of gotten to the point where most people that I'm seeing, it's age 67 is full retirement. That's when you get the most or your full benefit from Social Security. So people look at their statements and they see 62, 65, 66, 67, 70. So full retirement age at age 67. If you take it before that, you get a reduced benefit. It's substantially reduced. And so every year that you wait, 62, 63, 64, you get a little bit more, but you want to reach that full retirement age and get that full benefit. Now, if you don't need the Social Security benefit, you can wait until age 70 or anywhere in between there, and it grows by about 8% every year. But at age 70, it doesn't grow anymore. We actually had someone come in that was 72 years old a couple of weeks ago, and he had never started his Social Security. So I explained to him, it's not growing anymore. You need to go ahead and turn that on. He said, but I don't need the income. I said, but you're just leaving money on the table. So rarely do I see that, but once in a while. And he was still, he just didn't need it. He was working at part-time. He wanted to. And so everybody's situation is different, but at age 70, it doesn't grow anymore. You might as well put it in the bank. But if you draw at 62, not only do you get a reduced benefit, but if you're still going to work and you're going to make over a certain dollar amount, I think the limit this year is $26,400 and some change. I don't have it memorized, but I have a chart. But if you make over that, you have to pay back $1 of every $2 of Social Security that you make. So you're getting a reduced benefit, you're not getting your full benefit, and you're having to give back $1 on every $2. It just doesn't make sense. Now, if you're not going to work and you want to retire early, that's okay. So the biggest question I get from people is, Jerry, when is the best time to turn on the Social Security? And it's really a tricky question because I have to look at their longevity in their family, their current health care, what is your health situation, what is your spouse's health situation, how close are your guys' benefits? You know, because a lot of times one spouse has a much higher benefit than the other. Well, if you turn that higher benefit on early and get a reduced amount, if something happens to you, your spouse is going to get the bigger of the two checks, but that check might be considerably smaller because you turned it on early. So for spousal protection, sometimes it makes sense to leave that bigger check and turn it on later. And we help people bridge that gap because, you know, people lose their jobs. They don't want to go back to work and learn a new profession, or, you know, they just feel like they've aged out of it. Whatever the reason is, they're saying, I'm not going back to work, so I need that check. Well, they might. That might be one solution. But we might also be able to look at their other assets and show them an income plan that can bridge them to age 67 and get their full benefits.
And this is exactly why we've got the phone number on the bottom of the screen. As many amazing federal employees as there are across the country, we know this to be a fact, that the Social Security representatives are not allowed to give you financial planning advice like that. So if you talk to somebody like them and say, well, when's the best time for me to turn it on? Or should I turn it on early because I need it right now? And how does this work with the rest of my assets to create an income plan? They're not equipped to be doing that, and they are not allowed to be doing that. So if you want to integrate your Social Security decision with the rest of your investments to create an income plan that you can't outlive, if you want to know what that looks like, call the phone number, schedule your appointment, and come on in. There's a couple of different ways that we can help you, or you can help yourself as well. If you go to ssa.gov, if you haven't already, you can start your account there, and you can start to kind of take a look to see what exactly you would get paid depending on what time you take it. If you want to, though, you can also do that in our office. We'll go into ssa.gov with you, and we'll start to create an income plan with you. So call the phone number, schedule your appointment. More with Jerry Means and the Means Financial Group right after this.
Hi, I'm Jerry Means with Means Financial Group. Market losses aren't the only risk in your retirement. One of the biggest and most overlooked could be the tax bill on your qualified assets like 401ks and IRAs. As tax rates change, so does the value of your retirement income. A Roth conversion may help reduce your exposure and create more predictability, but timing and strategy matters. Want to see if a conversion could be right for your plan? Take the Roth conversion quiz today. It's free and it could help you make a more informed decision about your financial future. Scan the QR code or visit meansrothquiz.com to take your Roth conversion quiz today.
Welcome back. We're here with financial advisor Jerry Means of the Means Financial Group right here in St. Louis, but we know we have some viewers in Illinois where I was born and raised as well, so hello to everyone out there. Today we're helping you with some money mistakes that can cost you. This one really surprised me, especially when you started telling me the story, that putting a trust together over a will, did an entire program on that. You've got a lot of social media on it as well. You do a lot of live events on estate planning as well. But not just having a will in protecting your assets, because a will can go through probate and there's cost to that, but you've seen people make money mistakes that can cost them in putting together a trust. How so?
Well, I'm going to try to explain this the best I can because I do about 3 workshops a month on estate planning, and we have an evaluation form that we get back from people that attend to give us feedback. And one of the big things that always comes up is, Jerry, we don't understand what funding the trust means. So I thought it would be a good idea because it could be a huge mistake. So I thought I would explain what that means. So basically, when you have a trust, think of it this way, Spike. You've heard about the vault at Fort Knox that supposedly holds all of the gold, right? And it's built around all of this security. It has guards, and I think it's a 22,000-ton vault that actually protects the gold. But we've also heard conspiracy theories that there's no gold in the vault. Can you imagine what a waste of time, resources, manpower, everything, finances
To build it, the security guards, all that stuff,
to be a hoax and not to have any gold inside there.
Yeah.
Well, that's what happened to Michael Jackson. Michael Jackson, when he passed away, he had a $700 million estate. That's what it was evaluated at. He had a trust, so he did some estate planning, but he didn't fund the trust. And what that means is nothing was owned in his estate by the trust, and nothing had the trust named as beneficiary. So it was just an empty vault. So he had this elaborate document set up, but no one ever took the time to say, okay, we need to make this the owner of your bank accounts. We need to make your house, this the owner of your house, or we need to make this the beneficiary of your retirement accounts. No one ever did that, so it was just an empty piece of paper. That's what I mean by funding the trust. You have to make sure that the assets or the funds are inside that account, or else it will not protect them. I have people come into my office all the time, Jerry, I seen you in a workshop, or I heard you on the radio, or I see you on TV, and they'll come in and they'll bring their big, beautiful binder, and it's in Boston gold by the attorney that did it. And they say, we have all of the documents. And I'm thinking, that's fantastic. That's one less thing that I have to help you with, right? So I start looking through it and like, this looks great. Then I get into their assets and I don't see the trust anywhere. And I'm like, well, if you pass away, you've got named beneficiaries on these accounts. And by the way, you don't have one on your 401k, things like that. And I'm like, we need to fund the trust. And like, oh, I thought the attorney did that. No, the attorney draws the document. They charge you the fee, and then it's usually on you to go fund the trust. And you need to take that to your financial advisor or know how to do it yourself. And that's what we help people do. So we're really trying to pull everything in-house. We're helping clients with estate planning. We're helping them with their financial and their written income plan. We're trying to do tax planning and making sure that they're not going to get hurt in the back end of their retirement by taxes. And we want to make sure that the trust is funded when we do that. So we're bringing that all in. And then my wife, Angela, helps out with the healthcare solutions. So we're really trying to be, I hate to use the words one-stop shop, but we really are trying to be there for our clients and help them with everything, every aspect of their retirement plan.
Legacy planning isn't just about what we're leaving to the grandkids afterwards. Legacy planning can be about protecting what you have, making sure that your income or whatever you save, your investments, can help you with possible long-term care and health needs later on, not only for yourself, but possibly for your spouse. You have also put together another free tool Let's see if we can keep our producer on his toes today. It's the meanslegacy.com. And at meanslegacy.com, it's a free quiz. It's getting some questions, pointing you in the right direction to think about some of the things that Jerry was just talking about. Not just what do you have, but where do you want it to go, and where do you want it to go efficiently, easily, no arguments, out of the courts. Set up the way that you want it to. So just to get you to think about some of the things that might not be forthcoming to you for thinking about what should you do and what should you put together, go to meanslegacy.com. It's a fun little thing right now. Keep watching the show right now. Type that into your browser or scan this QR code over here if you want to, and keep listening before we run out of time here today. At the Means Legacy, that is great. How for you do you put those pieces together as a financial advisor? Man, so you look at somebody's trust and you can see through the documents that there's nothing in it. It's like an empty refrigerator.
Well, I usually find that out when I'm doing the discovery on the financial planning. You know, they're coming in to see us because they're wanting holistic planning. And they're saying, Jerry, here's my 401k, here's my IRA, here's our bank accounts, here's our after-tax accounts. And I start going through. I'm not just looking for what holdings they have. Of course, that's an importance. We want to look at diversification, as we were mentioning earlier, and their risk tolerance and make sure it's lining up. But I'm wanting to know who are the beneficiaries on each account. And sometimes they're not really sure. They say, it's in my trust, or they'll say, my wife, and I'm saying, okay, but you have the trust over here. You know, you set that up for a reason. Maybe we need to have the trust as beneficiary. Not always, not everyone needs a trust, but everyone should have the conversation to find out if they do need one. And that's what we offer to people. So when they come in, we're helping you with estate planning. We're helping you with tax planning. We're helping you with income planning. We're making sure that you're diversified. We're going to give you a written income plan. We do all of that for no cost, no obligation, just to come in, talk with us, to get the plan. Now, if you decide to work with us, that's fantastic. More people decide to than don't, Spike, is what we find once we do all of this work. But there's by no means any obligation. They can come in, sit down with myself or one of the other advisors. Just give us a call, 844-878-1293. It never hurts to be more informed, get a second opinion, make sure that you're okay. Worst case, you walk out and say, hey, I feel pretty good about myself. I've done things right.
Thank you so much for watching. Call this phone number right now. Schedule your appointment. It is no cost, no obligation to you. Thanks for watching.